It gets settled in, folks. Welcome. Can you hear me? You're talking too loud. Can you folks hear me? Okay. Maybe if you stop talking, then you can hear me. Sorry. The first class back. Those speakers never come on. They're not meant to. Those speakers, you mean? Those are only for people who give speeches here, not for classes. So I think it just comes from something else. I have no idea what it is. These are just set up as ornamental, I think. You should, I mean, I hate this room. I absolutely hate it. But it's the only room I've taught in for like 27 years now. Everything I teach ends up in this room. So it is what it is. Now we have to make the best of it. I'll tell you the part I hate most about this room is you put nameplates and you can see people's names and the other. You can't do that here. I've tried to think of a way to do it. Maybe hang it around your neck, put it on top of your head. But maybe like a Zoom thing, if you can have a digital version of your name in front, we'll figure something out. But this is corporate finance in case you're in the wrong class. Right? You know you're getting old when you start counting the years. This is my 39th year teaching corporate finance. I've been married only for 36 years. I can actually span my lifetime by corporate finance classes. I got news that my wife was going to labor with our first son while I was teaching a corporate finance class here. Not here, but that time downtown. So this is going to be an experience. I hope a good experience. No. But I'll make a confession before I start. As you know, I teach 2 classes, corporate finance and valuation. This is my favorite class. Don't let it out of this room, which is kind of a silly thing to say because it gets recorded, watched on YouTube. Who knows how many people know the secret. But if you're going to pick one class to take, not just one finance class, one class to take in business school, this is it. That's my biased perspective. But everything else is really a spin-off on this class. So I'm going to spend today's session laying the groundwork, the first 20 or 30 minutes with the logistical details, and then giving you what I call the big picture of corporate finance. And I make another confession. If you get today's session, the rest of the class is icing on the cake. You don't really need it. It's details and models and tools and techniques. So this is the class you want to be engaged in, which is good because you're still fresh, you're not jaded yet. That cynical part will come in later. So let me start this process by giving you a few of the logistical details. First is my office is in the other building, 969, and I'll set up Zoom office hours for those of you not comfortable being in an office physically with me, and that's fine. So I'll set up Zoom office hours. The office hours are going to be, actually, there's a 9 a.m. to 10 a.m. office hour. You can add it on Monday and Wednesday as well. So there'll be office hours both at the start of the day and the middle of the day on Monday and Wednesday. And because I'm teaching the valuation class to the MBAs and the undergraduates in the afternoon, the morning session might actually be easier for you because you're already here for the class, hopefully by that time. So, the office, and as I said, I'll send out the Zoom link for the office hours. If you want to, come in on the Zoom session during office hours, that's fine as well. I have a principle called the fair game principle that applies to office hours. And here's how it works. If you catch me, I'm fair game, which means for the next 15 weeks, I'm going to try to make it as difficult as possible for you to catch me. I do things like taking the stairs because I've noticed MBAs don't like to take the stairs. Yeah, there used to be, it used to get so bad that the new building that came up, the Paulson building, that used to be the gym for NY. It was called the Cold Center. For the longest time while I was teaching this class, I'd go to the Cold Center in the middle of the day to work out. And while the class was in session, you'd have people from the class showing up at exactly that time. I'm sure it's pure coincidence, getting on the treadmill right next to mine. Again, pure coincidence, and then ask me questions about the class. So, that's still fair game, but I cannot be responsible for the answers I give when my pulse rate exceeds a certain number. So, if as I'm climbing the stairs, if you catch me on the first floor, you'd probably get a good answer. 8th floor, probably not so good. No, so catch me, but the easiest way to get to me is my email. So if you get stuck, you have a question, don't wait till the next day, just send the email out. And if I'm awake, I'll usually respond. The teaching assistants for this class are 2 people who took this class last year. So they are intimately aware of the torture involved in this class and the details of this class. So take advantage. And I will send you their office hours, and they will have a review session each week where what they will do is cover questions from past quizzes covering the material for that week. Because I'm not going to work through problems in this class. That's not the objective of the class, but they will work through the mechanics of problems if that's where you're getting stuck. Now, in terms of the pre-class prep, it's too late for it now. But if you've been reading your emails, you probably know that you've already received 2 emails, I think, so far. 3 emails, I lose track of them. There'll be 114 by the time you're done. So this is just the beginning of the avalanche that's going to come at you. I suggested that there are 3 skill sets you need for this class. First is basic accounting. I know you've taken an accounting class, but accounting classes seem to go through an entire class and miss basic accounting. Don't ask me why. But if you're still confused about the difference between operating income and net income, you might want to revisit accounting. So in my attempt to fix what I think are holes from accounting classes, I've created my own version of an accounting class. Accountants probably blanch at what I say during that class, but I don't care. But it's a 12 session, it's like a 3-hour investment. So if your accounting is shaky, that might be something you might want to revisit. The second, you've taken a foundations class. How many of you are taking foundations simultaneously with this? Because it's allowed. How many of you took foundations in the first semester? Okay. Now, with foundations, I hope you've come out of that with the recognition of what present value is. Not a PV button in your calculator, but what present value actually is. If you're still a little confused about present value, the difference between a straight bond and a convertible bond, then maybe you want to take my foundations class, which is kind of a revisiting what I think are the skills I need for my class. It's very selfish. It's all about what do I need, and I create a class around it. And third, we live in a world of big data, right? We hear this word all the time. And you know what? We're surrounded by data, but we're actually getting worse at dealing with data. I mean, think of just the last 3 years with COVID. Think of how badly we've dealt with data. And the skill set you need to deal with data is statistics. And the tragedy is the way statistics gets taught makes you sure that you will never want to encounter statistics again for the rest of your life, which is too bad. Right? You read that, you do that multiple regression statistics. Thank God that's over. Thank God I will never have to do that again. But it's a great skill set to have in the world we live in now. It's more critical now than 30 years ago, 50 years ago. And in finance, this was the place where big data was created. Remember, we dealt with big data before big data became a thing. So in finance, we're constantly dealing with large amounts of contradictory data. So when you look at growth for your company, there's somebody saying there's high growth, and it's another data point saying there's low growth, and saying, which one do I use? Statistics can help you break the tie. So again, I've created my own version of a statistics class on basic skill sets and statistics. So if you don't know the difference between a correlation and a covariance, you're still a little confused. It's like a 3-hour investment again in statistics. So I know it's too late to do it now before the next class, but if you find yourself shaky somewhere along the way, then this might be something you want to use. As I said, this is the start of the torture. So I'm going to give you what a typical week is going to look like for the next 15 weeks. Monday, we'll have class, just like this one. About an hour after the class, you will get an email kind of summarizing what we did during the class. You're saying, but I was in the class. Physically, you might have been in the class, but mentally, who knows where you were at that point in time. And we all have these mental lapses where our brain leaves for like 10 minutes in the middle, say, oh my God, what happened? Yeah. So the email said, this is what we did during the class, and I'll give you a few things that you might do to kind of wrap up that class's material. You get to Tuesday, I'll send out what I call the corporate finance story of the week. I'll give you a preview. This week's story is a very old one. You know what the business roundtable is? It's a bunch of fat cat CEOs of large companies getting together and having somebody write things for them that they all sign off on. So sometimes those people writing things for them write really stupid things. In 2019, the Business Roundtable put out what I thought was the most ill thought out, stupidest statement ever. And basically, I call this the Kumbaya statement, which is the objective of a company is to keep everybody happy. This is notion of stakeholder wealth maximization. And the only people who actually say that are people who've never actually had to make a business decision. It's the dumbest idea ever. I lost my censoring mechanism about 10 years ago. So you'll hear me say things about ESG that might make you really uncomfortable. But that's okay, go out and throw up and come back in again. You know, I'm still going to keep talking about it. So this week, I'm going to put out the statement. I'm going to put out a blog post I wrote about the statement. And then I'm going to ask you to talk about it because that's my view. So talk about what, stakeholder wealth maximization versus shareholder, because that's at the center of this class. I haven't thought of next week's story yet, but I have an idea. You might have heard about the Adani Group, which is one of India's largest companies. And at the end of last week, a group called the Hindenburg Group, which is a group that short sells stocks, put out a 200-page document on what they call fraud. And this is one of India's largest companies. It lost 50 billion in market cap in one day after that report came out. We're going to talk about corporate governance. Corporate governance is really about how much power do shareholders have in companies. So where does the power lie in a company? Family group companies, you know where the power lies. It lies with the family, which is neither good nor bad. The family could be a good family or a bad family, but you're completely at the mercy of what the family decides to do. So next week, I might throw out the Adani Group. Maybe I'll have a post by then and then ask you, well, what would you do if you were a shareholder in a family group and you did not trust the family? So every week, I'm going to pick something up in the news that week. Throw it out there. And again, it's completely optional. If you say, look, this is a waste of my time, I don't want to think about big corporate finance issues, just let it go. On Wednesday, again, we'll have a class and a follow-up to the class. On Thursday, I will send you what I call my nagging email. What is that about? There's going to be a project that I'm going to describe today that's going to run through the next 15 weeks, where you take a company and essentially do everything with that company, what I do in class with the companies I pick. So it's going to be a lab experiment that you're going to be running for the next 15 weeks. You're going to be doing it as a group with each person picking a company, but it's going to be your choice. You can pick small companies, large companies, US companies, foreign companies, even private businesses, if you feel you can get the financial information. So if it's your family business or a friend's business, you want to pick that, that's fine. It's a 15-week project, and the project is due on May 8th. If you check your calendar, that's the last day of class at 5 p.m. Now, I'd like you to do the project during the course of the semester, not on May 6th or 7th. But I know how this works. You have the best of intentions right now of keeping up with classes, but that'll slip. So you know what I'm going to do? I'm going to nag you every week. So where are you? I'm going to send you like a GPS. This is where you're supposed to be. This is where you are. It will not work on most of you because denial is one of humanity's best qualities. So, I don't know what's going on. But maybe it'll prod you into action, saying, maybe I need to move a little faster. On Friday, I'll send you what I call an in-practice webcast. What is that? We talk about stuff in class, about getting a risk-free rate in Indonesian rupiah. So I'll describe the process and you'll see me go through the process. And you might think you get it, but then let's suppose you want to get a risk-free rate in Brazilian real tomorrow. You're saying, well, I don't exactly know where to go get the data, how. So in the in-practice webcast, I'll take you through the process, starting with where I get the data and how I clean it up to answer a specific question. And that'll be every Friday through the semester. On Saturday, you'll get a newsletter. There's not much news in it. Basically, it'll tell you what we did during the course of the week and where we're going next week. Why? Because when you're in a big class, it's easy to get lost. I mean, especially as you go towards the middle of the semester, midterms are coming. You say, where were we in the class again? So the newsletter is really about keeping you grounded. And this is where we are in the class. This is where we're going next. On Sunday, I'll give you a week ahead preview. This is what's coming next week. And this will repeat itself over and over. Spring break, I give you a week off. I won't email you for 7 days. But enjoy that moment while it lasts, because it's not going to last. Okay. Now, in terms of the classes themselves, now, I would like you to be physically here. It's so much more fun teaching to a class full of people than a class not full of people. But I do understand that, there will be other things that get in the way. You might have an interview, you might get sick. And if that happens, there is a Zoom link, which will be the live session. But I'd prefer that this not become a Zoom class where you just stay back and just say, no, this class is late enough that you can't say, look, I'm still sleeping in. If you're sleeping in at 10:30, maybe you want to reconsider your life choices. Because this too shall pass in 2 years. You can't do that anymore, I think. Because you'll have a job and you can't say, I'm sleeping in today, so I'm not coming into noon. Now, when you come to class, you don't have to bring any textbooks, but I will go through slides in class, and every one of my slides is in the lecture note packets. I've sent you the link already. If you can bring those slides either digitally, so if you have it on an iPad or in your computer, bring it in, or if you want to physically print it off, may the guilt be on you, not on me. The Brazilian rainforests supposedly are dying and you're contributing, but that's okay. But that's the only thing you need to bring to class. And even that, the only reason I like you to bring it to class is if you want to make notes, then you can make it on the side of the slides, digitally or physically again. And as I said, if you do miss a class, there will be a live Zoom session. That Zoom session will be recorded, so you can watch it later if you clearly can't even make it at the class time. I know there is a learning management system called Brightspace. I've never used any of the learning management systems that NYU has offered me in the last 30 years. They're like 5. We've gone through Blackboard and NYU classes. I don't like closed systems. And university learning management systems are closed. Closed to whom? Just to people who are NYU students. Everything that you need and will use for this class will be on the web page for the class. And the link is right there. So if you go there, it'll basically tell you everything you need for the class. So that will be the place to go. If you say, hey, I want to find past exams. I want to look at lecture notes. I want to look at past webcasts. I also will take the classes I record on Zoom and convert them into YouTube videos. There's a playlist. And the reason I do that is actually very pragmatic. You know that YouTube, one of the nice things about it is that adjusts to whatever bandwidth you have. So if you take NYU classes and you try to watch an iPhone with cell service, it's going to be incredibly difficult because you don't have enough bandwidth. YouTube adjusts for that. So it just makes it easier for you to. So it's the same lecture. So don't expect something different there. It'll be the same lecture on YouTube. As I said, there'll be lots of emails, and you will claim very soon that you did not get a particular email, and I will not believe you. But even if that is the case, here's what I'm going to do. Every email I send you, I will put into what I call the email chronicles, which will start starting. I think my first email was January 9th or January 16th. So basically, you will see every email sent out. So you have no excuse for missing an email. Just go check the chronicles. It'll give you every. So the proof will always be that that was sent out 2 weeks ago. You should have known about this. More piling on. There's a Google Calendar, which basically lists out quiz dates, exam dates, project due dates, etc. on there. So check it out. There is a blog that I write, and it's not deep. It's not particularly insightful, but it's mine. And I write only about, so I don't write about personal life and massive reincarnations. I talk about corporate finance and valuation. So it's very relevant to this class. So you've already received the first 2 links for the data updates I've done this year. Those data updates are really about, here's what I'm seeing in the data. And one of the reasons I do look at the data, because in corporate finance and valuation, one thing we need is perspective. For instance, if I asked you whether an operating margin of 16% is high or low, what would your answer be?
That depends.
Depends on what?
Structure of the company.
Okay, but so let's say I give you a structure of the company, and I said this is a really good company. So, but then to make sense of it's a high or low, you need a sense of what margins look like in the cross section, right? If I say I earn a 30% return on capital, you say, is that a high number? Is that a low number? Right now, for most of you, I would assume that you don't have that sense of perspective. Nobody does. The reason I look at the data is to keep myself honest. In what sense? When I value a company and I like the company, what do I feel the urge to give it? A 55% margin. You know how many companies in the world have 55% margins? Like 10. Some of you who track my blog know that 2 days ago, 3 days ago, maybe I posted my valuation of Tesla. And this is almost guaranteed to get you grief. Because when you value Tesla, you hear from both sides. Both sides in what sense? This is a company where people either love the company, they think it's the greatest company in the face of the earth, or they hate the company. They think the whole thing is a scam. So I get abused from both sides, and I just ignore it. But there are people who know a lot about Tesla. You know, if you look at my valuation, I've given Tesla $400 billion in revenues 10 years from now. And the reaction they give is only 400 billion? You say, what do you mean only 400 billion? I also give Tesla 16% margins, which is much higher than a typical automobile. Only 16%? So I'm going to respond to them. I actually went through the data, and the answer is in the data. Now, how many companies in the world have revenues that exceed 400 billion right now? 5. There's 2 of them are retail companies, Amazon and Walmart. There's Aramco in there because it sells a lot of oil. A lot of oil companies actually show up in the top 10. 5 companies. None of them are automobile companies. The largest automobile company in the world, which goes between Volkswagen and Toyota, is about 280 billion in revenues, maybe 300 billion in revenues. So my response is 400 billion is a lot of revenues. I'm making your company special. I'm making it really special because of those 5 companies that have revenues that exceed 400 billion. Guess how many have margins of 16%? 0. None. They all have single-digit margins. So when I give a company 400 billion in revenues and 16% margins, I need to be aware of the fact that this is an exceptional company. The only way you get to be aware of it is by looking at the data. So if you get a chance, keep track of those data updates. The third one is going to go up today or tomorrow on interest rates and default spreads. There's nothing special, but it's again going to give you some grounding on this is what the numbers look like at the start of 2023. And finally, I do have a Twitter account for the moment. I might get suspended at any moment because I did mention Elon Musk in one of the tweets I sent out about Tesla. Nothing terrible, but who knows what will happen. So for the moment, I do have a Twitter account. I don't involve myself in Twitter fights. My Twitter account is designed for one purpose and one purpose alone. Twitter is a great platform to direct people to something that you've done, a paper you've written. So I use Twitter to basically let people know I just posted on my blog, and then That's it. I just don't respond to any of the people who might come in and say whatever they want about it. But if you track I'd like more followers. Actually, I don't. But if you want to follow me, you're going to find out over the next 15 weeks if I valued a company, if I've written a post. So it's up to you. Is there required material? The only thing that is required is the lecture notes. Everything else, in terms of reading, is optional. If you do want to buy a book, there's a book that is actually tied very close to this class called Applied Corporate Finance. It's a book that I wrote from the class, so it's going to be, so if you want a book, no, but I have to warn you, it's obscenely overpriced. I wouldn't buy the book, to be quite honest, because I don't want to spend $100 or whatever they charge. But if you can find it cheap somewhere, I would go ahead and get it. Now, if you want practice problems, practice problems are on my websites if you want to get your hands dirty. And I would strongly recommend that you get your hands dirty, because you learn corporate finance by doing, working through numbers. You might understand a concept, but until you actually apply it. And every exam or quiz I've ever given in this class, and remember, I've been teaching it since 1984, which is the first year, is on my website. You can download the quiz. Until 1998, I gave midterms, not quizzes. And then I realized by the time you take a midterm and you get the feedback, it's too late to fix whatever's wrong with the class. So that's why I moved to quizzes. But so I'd go back at least to 1998, which is 24, 25 years of quizzes. And every quiz with the solutions are on there if you want to get your hands dirty. Okay? And as we go along, I'll point you to tools that you can use for this class. So I don't want you to spend your time learning Excel in this class. To me, it's kind of a useless skill because a machine could probably do it. So I'm not going to give you that task of build an Excel spreadsheet from scratch. So I'll do the building for you of the spreadsheets and point you to the spreadsheets. And I'll point you to data that you might need, again, because I don't want you to spend all of your time collecting and assimilating data. So now let's talk about the class. Anybody here taken a corporate finance class or worked in corporate finance before you came back to NYU? Okay. You took a corporate finance class, you worked in corporate finance. Okay. And what did that class cover?
Interest rate.
It's not a memorable class, I can see. So financing, maybe a lot of time on financing. Okay.
On financing. It also talked a lot about
if it doesn't come back to you quickly, then obviously that whatever they were talking about didn't connect together in some narrative for the class, right? Lots of different topics you might have covered. Interest rates, financing. Did you talk about discounted cash flow? So you did a little bit of that. So as projects or valuing the company? Okay. Okay, so let's pick somebody who actually worked in corporate finance at an investment bank. Nobody? There used to be a point in time when if I asked that question, 60% of the class were recovering investment bankers usually. Okay. That's healthy, I guess, that we're not there anymore. But corporate finance, when I first was given the class, was a collection of topics. At least that's what I was given. Many corporate finance classes spend an incredibly large amount of time on the financing part of corporate finance. How do we raise money? What's the right mix? And if you work at an investment bank in corporate finance, it's almost all financing. It's about how do you raise money? What's the right way to raise money? Should I issue straight bonds, convertible bonds? What's the cost of borrowing? How do I minimize the equity issuance cost? That's not what this class is about. This is not a class that's going to prepare you for an investment banking job. In fact, it'll make you worse at an investment banking job because it'll make you question every single thing you're asked to do. Why are we doing that? Because most of the things investment banks do don't make sense. This is not a class about preparing you for consulting either, because in consulting, there is a hefty amount of corporate finance consulting at a McKinsey or a BCG or a Bain. This is a class about the financial principles that govern how to run a business. Now, if you want to use that as a consultant, all the more power to you. As an equity research analyst, amazing. As an entrepreneur, as a venture capitalist, I'll give you my definition of corporate finance. It's incredibly self-serving. You know what corporate finance covers? It covers any decision that involves the use of money. Let me ask you the question again. How many of you were involved in jobs where money was actually being spent? How the heck the rest of you even, money is always being spent, right? Even if you're in a nonprofit, somebody's spending money. If nothing else, to send you a paycheck, there's money coming out. Hopefully you're doing something that gets some money going in. You're all corporate finance people. You just didn't realize it till this moment. You thought you were working in marketing. Guess what? You were working in corporate finance. I don't know whether they still do this, but the week before you enter the MBA program, do they bring you in and orient you? I call this the brainwashing week. The objective of this week is to convince you that what you've done with your life so far is completely useless. But the next 2 years are going to magically change your life. It's a complete lie. But how else can we charge you $200,000? So about 10 years ago, they made the mistake of inviting me to be part of that orientation. I don't think they're going to make that mistake again. They said, can you come in and talk to the entering MBAs about your corporate finance class? Because it's a class that many of them end up taking. So I came in with this chart. I said, this is what the MBA program looks like. That's my class. And there is all these other classes that feed into mine. That accounting class, you know what the entire purpose of that class is? To be able to give you a way of dealing with the raw data that you need in corporate finance. That marketing class, we talk about price and promotion and distribution systems. The entire objective of that class is to give you the tools to assess margins so you can do corporate finance better. I'm probably exaggerating, but I don't think so. Everything else in this program is in service of this class. Which should work both ways. Hopefully this class will make you better at all of your other classes. So the corporate strategy class, when there's that BS level that gets to a point where you say, I can't take this anymore. You've all reached that point in strategy classes, right? You say, why? What is it? You reach a level of abstraction. You say, I want to run a business. What the heck is this even supposed to mean? Maybe your corporate finance can help you. It'll make the lives of other professors perhaps a little uncomfortable, but that's not my problem. This is a class about everything. In fact, I have 3 objectives for this class. In the very last session, I'm going to come back and see if I've accomplished these 3 objectives. First is to give you the capacity to apply. Keywords apply. The tools and the models. We've developed in the last 60 years in corporate finance, all these tools and techniques and models, but I'm not interested in them for the purpose of having tools, techniques, and models. It's in applying those. So by the end of this class, hopefully when I give you a tool from corporate finance, you will know how to apply it. This is an applied corporate finance class, and the keyword is applied. Second, this is a big picture class. I know every class claims to be a big picture class. I'm going to actually show you the big picture for this class. And everything in this class is going to come out of that big picture. So, in teaching, there's something called elevation, where as people get stuck in details, you pull them up and say, this is where you are, and this is why it matters. I'm going to constantly try and do that with you, with every corporate finance principle or model. We say, this is why we're doing it. And the third objective is going to sound a little sick, but humor me anyway. I think corporate finance is an immense amount of fun. If you truly get the first principles of corporate finance, things are going to start to click. When you see a company do something, you're going to be saying, hey, that's what's happening there. When you see people making up stuff, you're going to be able to say, you're just making up stuff. When you see companies do stupid things, you're going to say, that doesn't make any sense. As I said, I have 15 weeks to convince you I can reach those missions, but I'll try. So I'm going to start off the class by kind of cleansing you of whatever accounting training you might have had before you came into the class. I want you to get out of the accounting mindset. I'm not an accountant, but I do use accounting information. Some of you might be accountants, and if you have an accounting mindset, maybe it's time to start to let go. To understand the accounting mindset, let's pick the accountant's favorite financial statement. It's a balance sheet. Accountants are the only people in the world left who actually think balance sheets matter. But let's humor them, right? What is the objective of a balance sheet? To tell the world what you own and what you owe, right? Let's cut down to basics. If you look at an accounting balance sheet, though, there's an incredible amount of detail, right? And the older the company, the more detail there is. Let's break the detail down with each one. I'm going to think like an accountant. I have to get out of this mindset very quickly because I can get sucked in and it's very difficult to get out. So let's go through an accounting balance sheet to see how accountants come up with the numbers that you see for each grouping of assets. First, you have long-lived physical assets, land, building, equipment, machinery, factories, plant, equipment. What's the rule in accounting still in much of the world when you have those assets? When you see a number for those assets, what is it that you see? You're seeing book value. And what does that mean when you say book? Book value is just a generic word for what's in the balance sheet. But where does that book value come from if it's a physical asset, a plant or an equipment? Basically, it's listing what it cost you to buy that asset, net of whatever the accountant says you've lost in value since. In fact, they have a word for what you've lost in value each year, right? What do they call it? Depreciation. Already you can see that if you bought something 50 years ago, what's its book value going to look like? Pretty close to zero. Older companies, physical assets are very quickly. Remember, the mark-to-market thing doesn't apply in physical assets. Let's move on to short-lived assets, inventory, receivables. It's still what you paid, but what you see on the balance sheet is going to be closer to what you paid because hopefully you haven't been keeping the inventory for the last 25 years. If you have, then you've got some serious problems. So it's going to be closer, but it's still what you pay. What about investments in other companies? You know what I mean by investments in other companies? Companies buy 3% of another company, 5%. These are classified as minority holdings. And here the accounting varies depending on who you are as a company. If you're holding these for trade, you have to mark to market. What does that mean? Accountants will come in, usually 10 accountants show up from Deloitte, and they will go into a room and they'll spend like 2 months saying, we're going to assess the value of what you own. They'll come out, smoke usually comes out like the Pope being, we've come up with a fair value, but they're trying. You got to give them credit. So if you look at a SoftBank, they actually have to reassess the value of what they own every 3 months, and that can change. Why? Because you do stupid things, the accountant has to record it. So when SoftBank invested in WeWork and thought it was worth 48 billion, they recorded it as 48 billion. But 6 months later, when you realize Adam Newman was a fraud and the company was a charade, you had to rewrite it down to 8 billion. And that was only because SoftBank came in and invested at 8 billion. Only reason for doing that is they want to see zero. So if you're holding it for trading, it's mark to market. That's different set of principles, right? Than what you did for physical assets. Already you can see accountants are internally not consistent in the way they record numbers for different assets. But if you're a company that buys a piece of another company, and not for trading, for strategic purpose, one of the more dangerous words in business, but let's throw that in there, which means, it's for the long term. You don't have to mark to market. I'll give you an example. In 2014, maybe 13, right after Marissa Mayer became CEO of Yahoo, I valued Yahoo. You ask you a question. How much would you value a search engine that nobody searches on? And an email program that only people over the age of 70 are attaching themselves to? The answer is not much. But I bent over backwards. I came up with a value of like 4 or 5 billion. Yahoo was trading at 40 billion. You say, that's absurd. You know why Yahoo was trading at 40 billion? Because there are 2 things that I had in value. 2 things of value that didn't show up in the earnings, the cash flows, and the financial statements. Anybody want to guess what those two things of value that Yahoo had? One was 21% of Alibaba, just on the verge of going public. You know what Alibaba went public at? $200 billion. What's 21% of 200 billion? You don't have to do the math. It's a lot of money. 40 billion plus. You know what was showing up on Yahoo's balance sheet? $500 million. That's a disconnect, right? You can disagree with what Alibaba is. What's definitely not 21% is not worth $500 million. Why? Because all that Yahoo had to do was record what they paid for the 21% when they made the investment. Already you can see across companies, there's no consistency. And then, of course, you have this grouping of assets. Let's call them intangible assets. Let's not think like accountants. Let's think like normal people. Let me ask you a question. Can the value of a company come significantly from things you can't see? What's the biggest asset that Coca-Cola has?
Brand value.
I'm glad you didn't say the syrup. Nobody cares about the syrup. They forgot that in 1986. Remember, they went to this new Coke, old Coke exercise. Coke doesn't even taste the same across the world. I live in San Diego. The only Coke I buy is the Mexican version because it actually tastes different and better than the US version. It's got nothing to do with taste. It's got everything to do with brand name. What's Apple's biggest asset?
Okay.
Brand is part of it, but there's an operating system. This is a company that actually spends money on styling and means it, right? It doesn't throw $20,000 at the end to make every computer different colors. Now we got the styling nailed down. That's what Dell thought they had to do for a while. This is a company that had John Ive, legendary thinker about design in the company, paid him millions of dollars saying, think carefully about whether the iPhone should have rounded edges or square. You might disagree with what they do. It could be styling, it could be operating system. It could be brand name. It could be the fact that they have an R&D department and a technology department that churns out new stuff. Do you see where I'm going? Out of the $2 trillion you have as market cap for Apple, very little comes from physical assets. That one infinity loop office building is a tiny fraction of the value of Apple. If you look at the biggest, most valuable companies in the world today, very few of them get their value from physical assets. So let's concede that intangible assets are a big chunk of value. So if you're an accountant thinking about balance sheets being recorded as a value, you want to bring intangible assets onto the books. That's what fair value accounting tries to do. It's a bit of an oxymoron because you can either do value or you can do accounting. You can't do both, but they're trying. But in spite of all the trying that accounting has done, if you look at intangible assets on balance sheets, not on market value, but in balance sheets, one item dominates. It accounts for 80% of all of the intangible asset value last year. You know what that one item is? Goodwill. Goodwill, the most devastatingly dangerous item ever created. And let's see why. Because when you think goodwill, not like an accountant, you think of, hey, this must be something the company has done that's good. We're going to account for it. But that's not what goodwill measures. In fact, for goodwill to manifest itself on an accounting balance sheet, a company has to do something. It has to take an action. What is that action that a company has to take? It has to acquire another company. Let's stop right there. Let's not even talk about the price. You acquire another company. The minute you do the acquisition, goodwill pops up. And help me out here. What does it measure? Quantifiable value. The purchase price and the actual asset. It's a difference between purchase price and something. Now, if you fall for the accounting words, they'll say fair value, but it's got nothing to do. It's book value marked up. So here's what happens. You have a company with book value of $4 billion. You paid $10 billion for the company. The accountant has a $6 billion problem to explain away, right? See why? Because until yesterday, what was he saying? Hey, the company's worth $4 billion. Oh my God, it's worth $10 billion. So here's what he does, or she does. They take the $6 billion difference, they put it on the balance sheet, they call it goodwill. And you know why you have to do it? Because balance sheets have a very unpleasant requirement, which is they have to balance. Goodwill exists for one reason and one reason alone, Without it, balance sheets would not balance. It's a plug variable. You see where I'm going? You're going to pick a company, you're going to look at its balance sheet, you're going to see 15 billion. You're going to say, this is amazing. The company has a lot of goodwill. No, it's just a plug variable. Every year I send these suggestions to the accounting standards board. They never seem to take them. So about a decade ago, I sent a suggestion that goodwill be renamed. I said there's tremendous amount of damage being done because people are feeling this urge to pay for goodwill because it sounds good. Let's rename it. In algebra, if two numbers don't equate, you know how you can make them equate? Just put plus x on the lower number and you're there. I said, let's call goodwill X. That would be a much more honest word, right? If you looked at a balance sheet, the X of 15 billion, you would feel the urge to pay for it. But in a long-winded way, here's what I'm saying. When you look at an accounting balance sheet, you're seeing a collection of different sets of rules, which are internally inconsistent, and it's not going to change. The reason it's not going to change is you have a legacy problem. You know, the legacy problem is you have 100 years of CPAs that you've churned out. And what have you taught them? How to record things using the old accounting rules. You can't say it's zero-based accounting. This is why fair value accounting is going to crash and burn, because you're anchored by legacy rules that are going to keep you bound up. And if you go to the other side of the balance sheet, again, you see a lot of clutter, right? You see current liabilities, short-term debt, long-term debt, accounts payable, supplier credit, and then you see shareholders' equity. Glorious item. It tells you something about the equity in the company. It's a book value of equity that we celebrate. But again, think about what the book value of equity for a company tells you about the company. It reflects everything the company has done in its history. When you look at Coca-Cola's book value of equity, if mathematically you ask me to write out that book value of equity, here's how I'd write it out. It's going to show the equity you raised on your IPO, which is when? 100 years ago. It's plus a summation of all retained earnings since, right? You think, so what? Accountants record the past. That's their job. They're rule-driven because that's how they roll. And when you look at an accounting statement, you're recording the past and you're seeing numbers that reflect accounting rules. This is fine. We need to start with that understanding. But here's what I want to try to do over the next 15 weeks. I want you to develop what I call a financial balance sheet mindset. You're saying, what's a financial balance sheet? It looks a lot like an accounting balance sheet in terms of the headings, assets and liabilities. But you look at the asset side of the balance sheet, what do you see? Only two items. Assets in place, investments you've already made as a company. So that's pretty simple, right? The factories you built, the products you've developed. And growth assets. You're saying, what are growth assets? This is the value that I'm attaching to things I expect you to do in the future. How far out in the future? As far as the eye can see and beyond. So I'm taking into account projects you might take 3 years from now, 5 years from now, 10 years from now, 50 years. You're saying that's absurd. I would never do that. If that's your statement, you will never buy a growth company, right? When you buy a Palantir or a Tesla, you're not paying for what they've already done. The bulk of what you're paying is for things you expect them to do in the future. Doesn't make it good or bad. It's just different. When you pick your company, I want you to think about, when I do the financial balance sheet for the company, is this the kind of company that gets a bulk of its value from things it's already done, or the bulk of its value from things it'll do in the future? It's going to change your perspective on that company all the way through. Anybody already starting to think of a company that they'd like to analyze? Come on, be my guinea pig. No? You pick Coca-Cola. Where do you think the bulk of your value comes from? Things you expect them to do in the future, things they've already done.
I would pick OpenAI as my company.
OpenAI is your company. So the bulk of your, in fact, all of your value comes from what? The future. Nothing bad or good, but let's carry. Let's suppose, I'm going to encourage you not to pick that for this class, and here's why. If you pick OpenAI as your company, and all of your value comes from what it'll do in the future, how much debt can it afford to have right now?
I I need to watch your accounting class.
No, you don't need accounting. You've started the company. If you're a young company, all of it happens in the future. You're going to be losing money right now because so you shouldn't borrow money, right? Why? If you're in a hole, what's the first rule? Stop digging. So you'll be all equity funded. How much dividends can you afford to pay out right now? Nothing. We're going to talk about how corporate life cycles govern what you do in business. So when you have a business where the bulk of the value comes in the future, guess what? They should be predominantly or entirely equity funded. They shouldn't be buying back stock or paying dividends. We've got corporate finance nailed down. You don't need the rest of this class. You see how identifying where a company is in the life cycle is going to give you insight into, hey, should they be focusing on investing? How much should they borrow? So I'm going to bring in that corporate life cycle structure. And having this financial balance sheet in front of you is going to give you some insight. Now, if you take a company like OpenAI and I look at their accounting balance sheet, how much book value of equity am I going to see there? What have they? Remember, I said book value of equity reflects their history, right? And this is a company with very little history. There's going to be nothing there. It's like writing the history of Slovenia. My wife is half Slovenian. And this is a country that's been a country only for what, 17 years. The history of Slovenia you could probably write in 15 pages, not like writing the history of Rome. The financial balance sheet for a young company is going to give you very little indication of what the company has done or is doing. So going through financial balance sheets and doing ratios for a young company is a complete waste of time. So financial balance sheets force you to think about the future. And that's healthy. Investing is about the future. Corporate finance, you got to live in the world you're in, not the world you wished you were in. And to the extent that companies are changing, you got to reflect what will the future deliver. So I told you I was going to give you the big picture of corporate finance. I'm going to deliver on that promise. This is the only page I hope you remember out of this class. Because if you get this, you've got corporate finance. So I'm going to give you the 3 basic decisions that or groups of decisions that every business has to make. Lay out the first principles that govern that decision, and everything in this class is going to be connected to those first principles. Every business, when you look at all the decisions they make, those decisions can be grouped into 1 of 3 groups. They can be investment decisions. What are investment decisions? The projects you take, the acquisitions you make, the assets you acquire. Every company has to make the choice, right? What do we invest in? Then there's a financing decision. What's a financing decision? The mix of debt and equity you're going to use to fund the business. Should I use 100% equity, 50% equity, 30% equity? What kind of debt should I use? That's a financing decision. And the final decision that you have to make as a business, assuming you pick good projects that start to pay off, is how much cash do I give back to the owners of the business? That's called the dividend decision. Investing decisions, financing. I challenge you to find me a decision that businesses make that don't fall into those 3 groups. And if it's a decision that don't fall into those 3 groups, my question to business is, why are you wasting your time? So let's start with the investment decision and lay out the first principle that's going to govern how we think about those decisions. Here's what the investment principle says. When you go out and take investments, make sure those investments earn a return that exceeds some minimum acceptable hurdle rates. Already thrown in a buzzword in there, right? Minimum acceptable hurdle rates. And what the heck is that? I'm not ready to give you the details. After all, this is the big picture page, but let me lay out the sub-principles that are going to govern how I come up with a hurdle rate. And as I go through this, I want you to think in common sense terms. This is not a corporate finance principle. It's a business common sense principle, whether it makes sense. The hurdle rate should reflect the riskiness of the investment. Riskier investments need higher hurdle rates than safer investments. Everybody agree with that? If I come to you with an investment with guaranteed cash flows, you'll accept a lower return than an investment with risky cash flows. And should reflect the mix of debt and equity used to fund that business because they might have different costs. So the hurdle rate should reflect the riskiness of the business and the mix of debt and equity used to fund that project. And when you think about returns on a project, how the heck am I going to measure return on a project? I'll lay out the principles again. It should be based on cash flows over the life of the project, not cash flows next year, but cash flows over the life of the project. So don't talk to me about short-term or long-term, because I'm asking you to look at the entire life of the project Cash in, cash out, as opposed to what? Earnings. I don't know, you can show me all the income statements you want, but it's based on cash flows. Should reflect when you get those cash flows. Yeah, ask you a question. Let's see how much common sense can kick in. Would you rather have a cash flow today or cash flow a year from now? Same cash flow. In fact, this is a test I ran on each of my 4 kids when they got to be 4 years old to decide how much money to set aside for college. So that's when their allowance started. And usually they got their allowance on Saturdays. So and each of them got to be 4. I would say, look, you get your allowance on Saturday every week. Would you prefer to get it on Monday, or would you rather wait till Saturday? Now, I could tell you the answer that would have meant, no, I'm not saving any money for college. They said, look, it doesn't matter. Just give it to me on Saturday. You really don't need any money for college. You're not going anywhere. It's common sense, right? You'd rather have money early than later. You don't need any indifference curves to know that there's a consumption preference for consuming today. Now, we can talk about with inflation, what happens to that number. None of them asked me that question, but what's the inflation rate? But one of them, my youngest, asked me a question, and I knew I was in trouble. He said, is it the same allowance, Dad? Well, that's an interesting question, because he said, I'm willing to make a trade-off. If I get $5 waiting till Saturday and only $4 if I get it on Monday, then I'll wait. Time value of money is not some elaborate financial concept. It's common sense. They skipped this entire session in Latin America. Imagine getting in front of Argentina and say, you know what? Cash today is worth more than cash a year from now. You come out of your mother's womb knowing this, right? Because essentially, inflation teaches you everything you need to know about time value of money. So when you talk about returns, they should figure out when you get the cash flow. So a project we have to wait longer will have lower returns than an equivalent project in terms of cash flows where you get the cash flows earlier. And should have all side effects built into it. There's a lot of garnishing in investment analysis. I know many of you worked at businesses before you came in here. I'll tell you what the garnishing looks like, and you tell me what you ran into this. So you've looked at a project, you've worked through the cash flows, somebody's done a lot of work, and it looks like the project doesn't pass muster. It's not good enough. That somebody in the group says, but there are strategic considerations. You know what that means, right? This project is going to get taken no matter what the numbers say. That's what the word strategic means. The numbers don't fly, but I really, 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 really want to do this. Think about it. Strategic projects, strategic deals, strategic buyers. What do they share in common? The numbers don't fly, but we're going to do this anyway. There's synergy. Oh, what a magical word. In investment analysis, it's my job, when you use these garnishing words, to bring them into the cash flows. Is there value to synergy? Absolutely. But I have to tell you how much additional revenues you're going to get or how much cost you're going to cut. Is there something strategic about it? Tell me what's strategic about it. Maybe there are other products that will emerge from this. Let's put that in. A good measure of return. There's no garnishing. It's all in the cash flows. And that's your job and my job when we look at investment analysis, to bring those words in. The investment principle says go out and find projects that earn more than your minimum acceptable hurdle rate. Let's turn to the financing principle. The financing principle says find a mix of debt and equity that minimizes your hurdle rate. Notice the word I used, your hurdle rate as a company. There is no one mix that applies for all companies. What's the advantage of having a lower hurdle rate? You get to take more projects and your projects all become more valuable, right? Would you rather be able to raise money at 9% or 10%? This isn't rocket science. You'd rather raise money at 9%. If you can find a mix of debt and equity that minimize your hurdle rate, you found the right mix. And then if you ask me what kind of debt should I take, long-term or short-term, dollar or euro, I'm going to turn the question back on you. So tell me something about your projects. You're an infrastructure company in Europe. You don't need a corporate finance class. What should an infrastructure company that is in Germany issue? What kind of debt should it issue? Long-term or short-term? Long-term. And what currency? Euros. This isn't, again, I mean, there's a principle in corporate finance, which is match the debt up to your assets. You might decide to violate that principle, but you better have really good reasons when you do it. We might talk about some of those reasons, but essentially your objective in corporate finance is to make sure your debt is matched up to your assets. That's a financing principle. And then there's a dividend principle. One of the things I find troubling in when you hear people talking about dividends is how they view dividends as a sign of failure. Company's paying a lot of dividends. That must mean its growth is lower. This is terrible. And I remind them of a farmer sowing seeds in the field, right? When you're a farmer sowing seeds, why do you do it? Is it because you like watching the plants grow? Maybe you do. You enjoy them while they're grown? Yeah, maybe you do. But what's the end game? You want to harvest the fields because that's why why do we start businesses? Because we like to watch them grow. It's nice to watch them grow. But eventually, if you're a successful business, what has to happen? You got to be able to return cash back to the owners. And if you're a private business, it's easy, right? You just take the cash out as the owner. I don't care what you call it. But if you're a publicly traded company, it's a little more organized. It can take one of two forms. It can either be in the forms. The old way of doing it was to just pay dividends. Until the 1980s, the only way of returning cash. But increasingly, and I'm going to show you how increasingly so this has become, companies have turned to buybacks, not just in the US, but across the world. And there's this elaborate disinformation about buybacks that I find horrifying in terms of the discussion, that buybacks are somehow destroying business at the core. Buybacks are just flexible dividends. Now, you might think a company is buying back too much or too little, but that's not a point against buybacks. It's just a point against that company. Now, whether you should pay dividends or buybacks is going to depend on who you are as a company. If you're Con Ed and you have a lot of cash, what you will do will be very different than if you're Google and you have a lot of cash. In fact, again, you don't need a corporate finance class to do this, but if you're Con Ed, you have a lot of cash. Should they pay more dividends or should they buy back stock? What does that depend on? It depends on what your investors like, right? How do you know what your investors like? They bought your stock in the first place. Con Ed has been paying dividends for 100 years. It's a big dividend paying stock. Guess who buys shares in Con Ed? Institutional investors who like dividends, older people who want the dividends. If you have a lot of cash, you should pay more in dividends. If you're Google, how much has Google paid in dividends over its lifetime? Zero. So who buys Google shares? People who like price appreciation. You're already seeing you don't need this class. You say, I get this. This is the big picture. I know this is common sense. In doing all of this, you have a singular objective, which we'll come back to, which is to maximize the value of your business. Notice I use words like share price. We'll come back and talk about how in practice this becomes maximize the stock price. They're trying to maximize the value of your business. This is corporate finance in a nutshell. And I'm going to use it to draw 5 very simple themes that are going to run through this class. In corporate finance, we have focus. When we look at project, we say, this is the right way to pick project. When you look at the right mix, this is the right mix for you. But that focus comes from the fact that there's a singular objective. Singular objective in corporate finance, as I said, is to maximize the value of your business. That's the good news. Having a singular objective gives us focus. You know what the bad news is? If you disagree with that objective, nothing in corporate finance will make sense. Now do you see why I'm going to take on the stakeholder wealth maximization objective upfront? Because if that is the objective, everything in corporate finance has to get rewritten. That's not my primary reason for taking it on, but your focus comes from the fact that you have a singular objective. So I'm going to spend probably the next 3 sessions talking about the objective in corporate finance. What are the alternatives? And I'm going to open the road to all the possible choices. Maybe it shouldn't be maximizing value. Maybe it should be maximizing market share, maximizing revenue growth, maximizing one of the acronyms that consulting firms come up with, EA, EVA, CFROI. Maybe it should be maximizing social good. I'll open up every door. I'll go in and essentially say, let's think about the end consequence of this objective and why maximizing the value of the business remains the core objective. Second, that focus is what, so when we talk about, about the focus, that focus comes from that singular objective, and disagreeing with that objective is fine. But remember, from that point on, if you say, I don't see why we use net present value to pick projects, your problem is not with net present value, it's with what's the end game for a business. What's going on here? My slides are going crazy. Let me fix it. I've already introduced this notion of a corporate life cycle, but you're going to see me come back to this over and over in this class, because to me, it's a very useful way of thinking about businesses. I've just finished, in fact, I finished my 12th book. It's about the corporate life cycle. So somewhere during the course of the semester, if it goes into print, I'll let you know. I believe that businesses, like human beings, go through a life cycle. A startup is like a baby. Needs constant feeding, not milk, but capital, right? A toddler is like very young company is like a toddler. Falls, gets up, sometimes falls and doesn't get up. Remember, the mortality rate for corporations much higher than the mortality rate for human beings. 2/3 of corporate babies don't make it through toddlerhood. Then you make it through those young years. What do you become? You become a teenager. What do teenagers do? You remember when you were a teenager? Every morning you got up, you looked in the mirror and said, I have lots of potential. What can I do today to screw it all up? Because teenagers have the time horizon of 3 minutes, right? Beyond that, you can't even think. And this is why somebody got who got admitted to Harvard does something stupid at a party 2 weeks later and gets that admission revoked. So what were you thinking? He wasn't thinking. He was a teenager. When I bought Tesla in 2019, this was right after Elon had gone through this, $420 or $410 or $420 funding secured kind of thing, and building cars and tents and stuff. The stock had dropped to 180. I bought the stock and I wrote about it in my blog. I called Tesla my corporate teenager. Do you see why it fits in Tesla? Company has immense potential, let's face it. But every morning, one man gets up, he looks in the mirror and he says, I have lots of potential in this company. What can I do today to mess it all up? Maybe I'll tweet about a Thai diver. What were you thinking? Maybe I'll buy $1 billion in Bitcoin. You're a $1 trillion car company. What were you thinking? But before you do that, remember, you're getting a package. You're complaining about the kind of undisciplined things that Tesla does. That's part of the company. It's a corporate teenage. You make it through the teenagers, you're at the peak of your life. What does that look like? The peak of human life. What does it look like? You go to bed at 3, you wake up at 6, you're a fully functioning human being, right? Enjoy that moment, because it doesn't, for many of you, that moment's already passed. The peak of your life, everything you touch turns to gold. Every project looks great. Everybody has only good things to say about you. Remember Facebook and Google 6 years ago? People forget that these companies were viewed as essentially untouchable. They're amazing companies run by superb people. They will never do stupid things. As I said, enjoy the moment, because after the peak of your life comes what? Middle age. Guess what, guys? It's coming for you sooner rather than later. And when you get to middle age, you know what you're going to do, right? I wish I was young again. I wish I could do that. No, it's not going to get you back, but you wish. But enjoy middle age while it lasts, because after middle age comes old age, and after old age comes dementia, and after dementia comes death. This is a cycle that sounds morbid, but companies go through the cycle. So let's throw a few companies, you put them in the life cycle. Tesla, probably a corporate teenager, lots of potential, who knows where they'll go. What about Coca-Cola? Probably approaching old age. You sell a sugared drink that's probably going to cause diabetes across much of the world. Your days are kind of numbered, right? What about GE? Well, this is beyond dimensions, a walking dead company, right? At this point, you say, please put it out of its misery. You pick a company, put it in the life cycle. Everything the company does is then going to fit. No, if you think about it, young companies should be focused almost entirely on investing. Don't talk about debt mix and dividends. It's about picking the right, because all your value comes from growth. Whether it's OpenAI, whether it's Palantir, the focus should be on investing. As companies age and their investment returns start to come down, guess what you think about? Hey, how do I lower my hurdle rate? Mature companies tend to focus on a lot of the financing principle. And then you get to be a declining company. You're focused on how do I get the cash out of the company, make the company smaller, and just go away. Much of corporate finance, you can look through the eyes of the, use that perspective, guess says this is why the company is doing what it is. In fact, I tell people, look, some of the biggest value destruction in the world happens when companies don't act their age. Old companies trying to be young again. And this shouldn't surprise you, right? Because as human beings, as you age, there's an entire ecosystem telling you can be young again. Who's in the ecosystem? Plastic surgeons. Just come on in, I'll tuck your chin in, and you look like you're 25 again. Physical trainers. You hire me in 6 months, you'll be as buff as you were when you were 22. You were never buff at 22, but you fall in anyway. Okay? There's an ecosystem telling companies it can be young again. You know who's in that ecosystem? Consultants. Let's face it, consultants would not have business if companies acted their age. Consultants, they can make the bulk of the money convincing companies they can be young again. So if you're going to consulting, you better hope and wish companies refuse to act their age, because there's your client base right there. Which brings me to the fourth theme, which is this, I think it's unfortunate this class is called corporate finance, because what's your first reaction? It must be for corporations, must be for publicly traded companies. Nothing could be further from the truth. This is about running a business. If you run a private business, do you have to make investment decisions, financing decisions? Absolutely. That guy who used to run the hot dog stand, I don't know what this is, I'll check it out, but that guy's been running that hot dog stand for the last 30 years in front of this building. There are many hot dog stands, but there used to be only one hot dog stand. He's still there. He's kind of getting priced out because there are other stands which are bigger and more offerings. I still remember when he went from having the small stand to a stand where he could be inside the stand in winter. And I walked by and said, this is great. You got a new, and I said, how much did it cost? It was, huge amount of money, $20,000, $25,000, something like that. And I said, a big investment decision? Huge. And remember, if he fails, he's not too big to fail. It's not like he's going to get a government bailout saying, oh my God, you're too big to fail. Let me give you 20,000. That investment decision is hugely consequential. I remember when he added sausages to the menu, he used to sell hot dog. Big investment decision, right? You're adding another product. My point is, every business faces these choices. And I would argue making them well is even more consequential if you're a small private business than if you're a large publicly traded company. So this is not a corporate finance class. It's really a business finance class because it applies to all businesses. And the fifth and final theme is all these first principles. They're pretty straightforward, right? But companies violate them all the time. And if you violate first principles, I have a reminder for you. It'll catch up with you. I'll give you an example. It's a company called SteadySafe in the 1990s. It was a company that operated taxi cabs in Indonesia. And Indonesia was going through a growth phase in the early part of the 1990s, so SteadySafe decides it's going to grow. So you're going to play the role of my investment banker, and I'm going to come to you for advice. In the early 90s, SteadySafe went to an investment banker in Southeast Asia called Peregrine. So at that time, fairly large investment bank in Southeast Asia. And they asked them a simple question. We want to grow, and we're going to borrow money to grow. So what does grow mean? Buy more taxi cabs, put them on the ground. So you're going to help me out here. Their question was, what kind of debt should we take? So let's start. How long-term should the debt be? You're allowed to ask me back questions. What am I going to do with this debt? I'm going to buy taxi cabs, right? So what's the question you're going to ask me? How long do taxi cabs last? If I say 10 years, your debt should roughly be 10-year debt. In what currency should the debt be denominated in? You're saying, what the heck is the Indonesian currency? Let me help you out. So rupiah. You run taxi cabs in Indonesia. When people get out of the cab, at that time, it's all cash, remember? They paid in rupiah. So if your cash flows in rupiah, your debt should be in. So this is a no-brainer, right? They should have taken on 10-year rupiah debt and they'd have been home free. They went to Peregrine, and Peregrine told them to take 10-year debt. Half the recommendation makes sense, but in US dollars. And they gave a reason that sounded very compelling. What is the reason they gave for borrowing in dollars opposed to rupiah? It's cheaper. I'm going to come back and address this point about cheaper. It is technically cheaper. They borrowed 9% in dollars, it would be 15% in rupiah. Is 9% lower than 15%? Humor me. Yes, right? Yes, your question is, what's the temperature in New York today? Anybody check the temperature today? Like 45, it seems pretty warm, maybe 45. This morning I was on a call with somebody in Frankfurt and I asked him what the temperature was. You know what it was? It was 10 degrees. It must be freezing in Frankfurt. It's actually not. If you ask somebody in Europe what the temperature is, what do they denominate the temperature? It's in Celsius. Is 10 lower than 45? Absolutely. Is 10 degrees Celsius lower than 45 degrees Fahrenheit? No, it's not. That's what happens when people compare rates in different currencies. They fall into exactly the same trap. So Steady Safe went out and borrowed in dollars because, there's an investment bank. They must know what they're doing. Terrible mistake. But for the first couple of years, it worked out. Things went swimmingly well. Until one day, it was 1996, Indonesia was in a deep crisis. Steady Safe woke up to some news. You know what the news was? That the Indonesian, in fact, at the time they borrowed the money, Steady Safe actually asked Peregrine, should we be worried about the fact that we're borrowing in dollars and taking projects in rupiah? And the investment bank said, don't worry about it. The government has pegged the exchange rate and promised us that nothing bad will happen. Famous last words, because 4 years later, something bad happened. The Indonesian government woke up one day and said, we're going to devalue the rupiah by 60%. Let's wake up to the morning after. You're Steady Safe. Your assets are all rupiah assets. They're worth 40% of what they were yesterday in dollar terms, right? Now, if your debt had also been in rupiah, that would have been marked down as well. You wouldn't have been happy about this, but you wouldn't have been in trouble. But in this case, they'd borrowed money in dollars. They'd funded projects in rupiah. So guess what happened to Steady Safe? They went bankrupt. The only good thing that came out of this is they took their investment banker down with them. It happens far too infrequently, if you ask me, because investment bankers are always there at the wedding. They're never there at the divorce. Actually, they're at both places getting fees and wedding planners, divorce law. Now, basically, but if you mismatch, people think they can get away with it. There's an entire business called the carry trade built on mismatching currencies. So you say, look how much money I made. One of these days, it's going to catch up with you. So one of the things I would hope you get out of this class is that capacity to be able to tell when somebody is violating a first principle. And we're surrounded by examples of this, partly because during the last decade, you could violate first principles and get away with it for a long. In fact, you got rewarded for doing it. And in 2022, it started catching up. But why are we surprised? The only question is, why did it take so long? So the entire class is built around this. Every session in this class, I'm going to show you the big picture and say, or at least for groups of sessions, this is where we are in the big picture. So we're going to start with the objective, then we're going to move on to hurdle rates. We're going to spend some 3 sessions on measuring returns and the financing mix. So everything in this class is about nailing down details about the big picture. And as I said, this is an applied class. And I'm going to apply everything we do on this class on 6 companies. So when we start this class on Wednesday, I'm going to talk about why I picked these 6 companies and how it's going to play out. But as you watch me with these 6 companies, you're not going to be able to passively sit back and say, okay, this is neat. You're going to be applying everything I do on these 6 companies on your company. So start thinking about two things. One is who you want to be in a group with. I'm not going to assign you to a group. And if you have trouble, I will create an orphan list for people who are unwanted. And you can then go on the orphan list and create a group of orphans. So I will do that. But you create your own group, you pick your own companies, and I will start next class with what structure you should have on picking those companies.